Hello friends, I am Abhay. In this video, we will deep dive into how sectoral corporate earnings are correlated with expansion or contraction in GDP. Which sector likely to be impacted most by any slowdown in economic activity and which sector likely to fend off any shock in GDP at least on short-term basis. It is widely believed that corporate earning growth are positively correlated with expansion in GDP. So let's see through data whether it actually happens on year basis. Surprisingly, the data does not support our common understanding. Year basis, correlation between corporate earning growth and GDP growth at current price has been negative. In this graph, you will notice that corporate earning has wild variation vis-a-vis GDP growth. There doesn't seem to be any interconnection between them. So let's find out what could be possible reasons as it challenges our common belief. Oil and gas sector is one of the major contributor to the corporate earning growth. Due to import dependency for crude oil over 85%, the profitability of the sector will not be impacted by any expansion or slowdown in domestic economic activity, as crude oil prices are subject to global factors, including ongoing geopolitical tension in Ukraine and Middle East. While IT sector also contributes large part to corporate earnings, export makes up about 79% of industry's revenue. Even pharmaceutical sector derives roughly 50% of their revenue from export. Finally, corporate earning of metal sector is also widely impacted by fluctuation in raw material prices and finished product prices due to global factors. While combined earnings of all sectors doesn't seem to be interconnected with expansion in economic activity, there will be some sectors which are likely to be positively related with GDP growth even on year basis. Let's find out sectors which have direct one-to-one relationship with economic activity, and any expansion or contraction in GDP would be immediately felt by the sector and would be reflected in their earning growth. Before we get into the sectoral earning growth story, let's have a recap of growth of Nifty index alongside expansion in economic activity. Our GDP at current price have grown over by 47% between FY20 and FY24, and the CAGR of nominal growth is roughly 10% during the same period. Now, if you look at GDP at constant price, the growth has been just over 20% between FY20 and FY24, and the CAGR of real growth is mere 4.7% during the same period. Now comes to the expansion of Nifty index since COVID period. From 31st March 2020 to 31st March 2024, the index has grown by whooping 160%, and the CAGR of the same is roughly 27%. It looks like GDP is trying to catch up with Nifty index, which is running like Usain Bolt. But is this Nifty data really comparable? Because it includes panic in market due to COVID. So let's first remove COVID related impact in Nifty and then compare the data. Here we have considered Nifty index as on 1st Feb 2020 instead of 31st March 2020 to remove COVID related impact. Now data looks bit comparable. Still, growth in Nifty index outpaces GDP growth by miles. With this background, let's now focus on sectoral corporate earning growth vis-a-vis expansion in economic activity. First, you'd like to note that we are comparing corporate earning growth with GDP at current price instead of GDP at constant price because earning growth includes inflationary impact. Secondly, we have not included IT and pharma sector because large part of their revenue comes from export. Therefore, these two sectors are not much impacted by domestic economic activity. Third, you would like to note that corporate earning is the cumulative earning of all companies included in the specific sectoral Nifty index. Now, what we can learn from the data. In this table, you would observe that barring two sectors, all other sectors have crazy type of earnings CAGR between FY20 and FY24. Outstanding are auto and banking sector. Their earnings CAGR is notably above 40%, which is the total expansion in GDP at current price during the same period. Now let's do another test to reconfirm sectoral earning relationship with GDP expansion. In this table, we have calculated correlation coefficient between sectoral earning growth and nominal GDP growth. Based on data between FY20 to FY24, the earning of three sectors, namely auto, FMCG and realty sector are strongly correlated with GDP growth. While banking sector is weakly correlated, the rest of the other sector have negative correlation with expansion in GDP. Let's now understand why earning in metal, energy and oil and gas sector have negative correlation with expansion in GDP. Let's now first discuss the oil and gas sector. As we have discussed earlier in this video, due to import dependency for crude oil for over 85%, the profitability of this sector will not be impacted by domestic economic activity, as crude oil prices are subject to global factors including ongoing geopolitical tension in Ukraine and Middle East. Secondly, energy sector in India is poised to grow as per capita consumption of energy in India in 2023 was still around 0.82, which is half of Asian averages. You would be wondering what is TOE? It is the unit of energy that is defined as the amount of energy released when 1 ton of crude oil is burned. Further, the corporate earning of metal sector is also widely impacted by fluctuation in raw material prices and finished product prices due to global factors. You would also be wondering why the earning of banking sector is weakly correlated with GDP expansion, which is contrary to our belief. So let's get into another data to find out the reason. In this slide, we have shown gross bank credit by major sectors. Here we have compared FY24 data with FY14 data when NPA crisis actually surfaced. One major difference you would note here that share of retail credit has increased by almost 10%, while share of corporate lending has decreased by close to 15% during the same period, considering the fact that overall bank credit have almost tripled between FY14 to FY24. This may be good strategy by banking sector to fend off NPA crisis due to large corporate default. But is it good news from economic growth perspective? Is private sector investing enough to ensure sustainable growth for India? Let's check out to another data. As you would notice here, though there is some pickup in capital investment by private sector, it is still below FY12 level. In fact, gross capital formation has not touched its peak level achieved in FY12. Capital investment is like seed for generating future growth. So now come back to the original discussion. As we have established that earning growth of auto, FMCG and realty sector is strongly related with expansion in GDP. So let's confirm this from the impact of slowdown in GDP on sectoral earning in S2 FY25. Wow, the earning data for S2 FY25 perfectly summarizes our findings so far. The earning growth of auto sector has come down to 12% in S2 FY25 as compared to earning CAGR of 40% between FY20 to FY24. The worst hit here is FMCG sector. Their earning growth in S2 FY25 summarizes the story of economic slowdown. The earning growth of banking sector has also slowed down, but not impacted as like FMCG and auto sector. While for Nifty realty sector, the base data for S2 FY24 is so small that it would be hasty to draw any conclusion from this data point. So if you like this video, please subscribe my channel and thanks for watching.